Are you a homeowner that has credit card debt and you're just struggling to figure out how to get ahead as the credit card debt might be growing? Here's a solution to consider. Depending on how much equity you have in your home, you could look at doing an equity refinance. And this is an interesting type of loan because it's not touching what I'll say is your first mortgage. So many homeowners out there, depending on when you bought, you might be at an interest rate under 4%. If that's the case, depending on how much of your equity you want to access to pay off high interest credit cards or the IRS or any other life events that come about, a lot of times it's like, what's the strategy to do that? Well, there is one, and that is called a home equity loan. Essentially, that's what it is. Now, you may have heard of home equity lines of credit. Those are a little bit different, but they're the same in the sense that these loans take a second lien position behind your first mortgage. So you do not have to touch that low interest rate first mortgage if that's what you have. Now, if you bought over the last couple of years and your interest rate on your first mortgage is higher, then we would look at a different strategy. But for this purpose of this video, I really just want to speak to those that are out there. They kind of feel stuck because they have this amazing low interest rate because maybe they purchased 4 years ago and that interest rate is just so low. They're just like, oh my gosh, I can't fathom letting it go. What do I do though? Because I'm also struggling with the rising cost of goods and rising credit card debt. So if that is you, listen up. Let's kind of dive into it. First of all, what the heck am I talking about? I am talking about an equity access loan. Essentially, it is a home equity loan that allows you to access your equity. And this is a closed-end loan, meaning that it's not open, it's not revolving. It will be for a fixed term. That term can be anywhere from 10, 15, 20, 25 years, and maybe even up to 30 years, depending on the size of the loan and if that payment helps meet your budget and what you're trying to accomplish. It does take second lien position, so it's accessing your equity, and it is a home loan. It is not a credit card. The cool thing about it is on these closed-in home access or home equity loans, your payment is a principal and interest payment. So just like you would think about a car payment, where when you're paying every month for a fixed period of time, that payment, some of that goes towards principal, some of that goes towards interest. When I talk with homeowners right now, one of the stressors is the credit card debt is growing, and as we all know, the minimum payments on credit card debts rarely really move the needle when it comes to paying down the credit card balances. So we have a client right now, and this is just a good story because I think we all connect to story. We have a client right now, past client of mine, and they have 5 credit cards and 2 IRS payments. They filed an extension on their taxes, and their last IRS payment bill came in October of this year. So in that case, now they had a tax bill from last year, now they have another tax bill. They've got the credit card payments out there and balances of roughly $40,000 on credit cards, 20 on the IRS, and they're just like, oh my gosh, what's one more thing, like one more payment? So what we did was we consolidated all of this into one equity loan. It is a second mortgage. It has a principal and interest payment on it. This client chose to do a 15-year term because it wanted to pay more towards the principal. And now they're freeing up cash flow every month at the tune of almost $700 a month. So now they can breathe a little bit, and they have confidence knowing that that credit card debt that the principal wasn't going down on it just by paying the minimum payments. Now they know, and they have a plan that now the credit card debt is wiped out. It does not exist. And going forward, if they want to pay off this home equity loan, they can do that strategically by taking some of the savings that they are saving every month. So part of that $700, if they choose to do that, and apply it towards the principal on this home equity loan and get that thing paid off sooner than the 15-year mark. So when we think about strategies, everybody's got a different story. I just want to get the word out and make sure that homeowners know that you're not stuck. If you have equity in your property, give us a call. Let's just walk through whether this makes sense for you or not. And again, it's not one size fits all, but these are solutions that many homeowners across the country are using to be able to reset the debt, reset the payment, and many times cash flow every month. So let's talk a little bit about the pros and cons. The interest rates on these equity loans are higher than first mortgage interest rates. However, they are generally much lower than credit card interest rates. So on average, credit card interest rates are anywhere from, call it 22 to 32%, depending on the credit card company. So if you can take that and you can drop that by more than half, if not more, 3/4, let's say. If you can get that interest rate, a sub 10% interest rate, now you're paying less interest. And so that's one of the ways that these home equity loans are helpful to people, because they can take these high interest credit cards that never seem to go anywhere and be able to take that payment down, and the interest rate is fixed and the term is fixed. So again, now you have the confidence of knowing that every month when you're paying the payment, part of that is going to the principal. Now the cons are you're using your equity. Like, let's just be real. You are tapping into the equity that you have either gained by appreciation. And as a reminder, appreciation is the difference between what you paid for the home and the current market value. Or maybe you purchased the home and you did a large down payment on the home. That difference between your mortgage balance and the current market value is the equity that you can access. Now, you can't access all of it, so just know that every lender out there is going to have kind of like a maximum amount of the accessible equity. But at the end of the day, you are accessing your equity to consolidate debt, to hopefully cash flow, or take care of whatever it is that's lingering out there. So this is a strategic type of loan, and again, it's not for everybody. And I will tell you this, after 28 years of doing this, there's no perfect loan, there is not. Loan means you are borrowing money. We get that. But the good news is that there are strategic ways to borrow money. There's strategic ways to leverage. And that's really what this conversation is about today. Here's another tip. These are mortgages, which means you're going through the qualification process. There's going to be credit score requirements. There's going to be debt to income ratios, etc. So whatever you went through when you took out your last mortgage, this is going to feel similar to that. There's also going to be some type of property valuation done. So the market value of your property currently, appraised value, not what you paid for it, not what you're getting in some automated system that you're signed up for that's telling you the estimated market value. There's going to be either an appraisal or some type of valuation done on your property at the point in time that the lender is originating the home equity loan. Now, here's something that's really important. And if this doesn't apply to you, but you have a friend or you know somebody out there that's just struggling with credit card debt and they can't pay the payment, because this is a mortgage and because credit score is going to drive the interest rate and the ability to get approved, it may be something for them to consider before they have a 30-day late payment on either their mortgage or any of their debt. Because as soon as that 30-day late payment shows up on the credit report, it is going to drop their credit score, and it could put them in a position that they can no longer qualify for this type of solution. So again, it's just important to know it is a mortgage. All the mortgage processes are going to take place, but it's a viable solution as long as you are aware, you understand, and you are working with somebody that can really kind of walk you through the pros and cons specific to your situation. I talked a lot about credit card debt because that seems to be the big pressure and the big conversation of late. But recently I had a conversation with a gal who was referred to me, and she has zero credit card debt, but she's in a similar situation because she and her spouse have a very low interest rate on their first mortgage, and unfortunately they're going through a divorce. So now they need to access some of that equity to be able to buy out the spouse as she's going to retain the property. So again, this type of equity access loan can also be used for things other than debt consolidation, credit card debt, paying off the IRS, etc. In this case, it could also be used to buy out a spouse if you're going through a divorce. And also just know it doesn't necessarily have to be a spouse. We have a lot of buyers over the years who are not married, whatever the situation is, that they purchase a home together, and now maybe one of the parties is moving on to do something different, whether that's buy another property or get married or just move forward in life. Now we have a situation where they together bought a home, they have gained equity in the home, and now the person that's departing wants to access their equity. And so this loan can help with that and not touch the first mortgage. And that's the key. Leaving that very low interest rate in place makes sense unless, and here's where it may not make sense. And this is why working really with somebody that can be very strategic, and that's what my team does. But let's say that you have a home that is worth $500,000. And let's say that you have a $100,000 mortgage on the house. Let's say the interest rate on that is 4%. That's pretty cool. But let's say whatever's going on in your life, because let's be real, life happens. It just does. And I'm giving you a few examples, but we all know there's a lot of different examples out there where life happens and it may make sense for you to access your equity. Well, let's say in your scenario that you need to access $200,000. Maybe you're just doing a big remodel. Maybe you're going to take that thing down to the studs and it's going to add to the value of your home. And this is something that you want to consider is accessing your equity to do that. In that scenario, because now what would be the equity loan with the two loan strategy exceeds the balance of the first mortgage, this strategy may not make sense. We may take a step back and look at just doing a first lien cash out refinance. So I know I've said a lot, and I'm sure your brain is just like, ah. But the point here is know that if you are a homeowner and you have equity and you need to think through solutions that could help you save money, cash flow, deal with whatever's going on in your life, or potentially even just do a remodel because it's time to do that, give us a call. To learn more, honestly, this is just a very casual chat. Reach out to us, call or text 480-725-0150, and we'll hop on a call and we'll see if it makes sense for you. The Kelly Zitlow Group is here to have these conversations and help you navigate how to best strategize with your equity.